Welcome to Tradespoon. My name is Vlad Karpel. I'm the CEO and founder of Tradespoon, and I'd like to talk about technical analysis. We covered support and resistance in previous discussions, and now we're talking about chart patterns. Chart patterns, in addition to upper and lower studies, are very important patterns. So let's look at some of the common chart patterns out there. Let's take a look at triangles. So what is a chart pattern? Price patterns are tools for displaying data that reflects investor psychology and sentiment. Price patterns can be used to project future price direction. Here we will look at the terms like trend, support, and resistance, as we've discussed in previous sessions, and most commonly used chart patterns. We already talked about rectangles in our previous session, so now we're going to concentrate on triangles. An ascending triangle is a pattern that appears during an uptrend. When a stock begins to consolidate between a flat resistance line, you have your overhead resistance line, and an upward sloping support level. Again, usually it happens during a binary event. You have bulls and bears kind of walking in those two lines. One is a parallel line, that's your overhead resistance, and one is the slope line, that's your short-term support. To be a valid ascending triangle, the price must bounce twice off both the support and resistance levels. Again, common on a breakout after 52-week high, and these are more prevalent when the chart patterns are forming over a longer period of time. You want at least weeks or months to wait for the chart pattern to form. And this is a continuation pattern. Unlike rectangles that we discussed before, triangles are continuation pattern. So let's take a look at the example. Here we see a stock being in an uptrend. May and June we are in an uptrend. But you're seeing that we are reaching a red line, overhead resistance at $72. You also see a slanted upward movement of green line on the upper side of the chart patterns. That is your short-term support. So the red line is overhead resistance. The green line is short-term support. It's an intermediate term uptrend, and the entry price for the setup is usually breakout above resistance. Once you see on July 11th, roughly on the above average volume, if you have a breakout of the overhead resistance on above average volume, that is entry point. Descending triangle is the opposite. If you see bearish sentiment and you see stocks selling off in May, June, and July, you see that the long-term support is the green line, and the overhead resistance is the red line that is slanted down. That means that there's less and less buyers in the market. And that's why you see a descending triangle. And then usually around the earnings, if the stock breaks out on above the volume, where you see here at $37.50, that is the sell signal. The sell signal occurs when the support, in this example, when the support gets break down on above average volume, at least for over several days. At this point, going long probably is not a good idea for this setup. Key point, unlike rectangles, this is a continuation pattern. So in conclusion, it's always important to be aware of dominant trend in the market. Price patterns can give you a glimpse of what the stock future may be in the future, and price patterns are not infallible. You should consider using Tradespoon technology that not only shows you the chart patterns, but it also predicts where the price of the stock might be, and it looks at the technical and fundamental analysis to put the odds in your favor. Again, you can visit our webinars at tradespoon.com/webinars, and you can follow us on social media to find out news about market, trade ideas, and different educational topics. Thank you very much.